762 million ounces. That is how much silver has been drained since 2021. That is nearly 3/4 of annual global production. That number does not show up in the price, yet. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. Now, silver sits at 80.33 while the physical market tightens underneath it. Let's get straight into it. Lead story today, the Silver Institute and Metals Focus. 762 million ounces removed from global stocks since 2021. Sixth consecutive annual deficit confirmed. 2026 supply now expected to fall 2%. Effective April 2026 outlook revision. This follows earlier projections that expected supply growth this year. That shift matters. The timing matters. The reversal from growth to contraction. That is not random. That is a pattern. The market is running on borrowed supply. Think about what that sequence actually means. A market drawing down inventory for 6 straight years is not balanced. It is being sustained artificially. How long does that last before something breaks? The ones paying attention already know what to watch next. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now. Subscribe to OG John AG 1.0 and share this with one person who needs to see these numbers. Now, back to the data. Before I show you the full data picture, consider this. The last time physical silver inventories were this stressed, price repriced aggressively within a short window. The data is already telling you something. Let's build it out. Now let's build the full picture, because the Silver Institute deficit does not exist in a vacuum. The Silver Institute 2026 outlook has dropped. Metals Focus confirms the same structural draw. 762 million ounces since 2021 across both datasets. COMEX reports registered silver at approximately 76 million ounces. CME Group data shows open interest near 576 million ounces. That is a 13.4% coverage ratio. Finance magnates flags below 15% as stress territory. Gold Silver reports 1.5 million ounces withdrawn in 30 days. That is a 1.9% decline in 1 month. Shanghai Gold Exchange pricing shows premiums between $3 and $10 per ounce. That is up to a 13% divergence from COMEX pricing. London Bullion Market Association data shows 884 million ounces held. Only 28% is freely available. That is the second dataset. That connects directly to the first. The rate of drawdown is not slowing. It is compounding. The data is doing the talking. The ones who were dismissed for calling a physical shortage are not being dismissed now. And here is what makes that picture even harder to ignore. COMEX coverage sits at 13.4%. That means 7.6 paper ounces per physical ounce. 6 consecutive years of deficit confirms structural imbalance. At the same time, industrial demand is forecast to fall 3%. That creates the tension. Weak demand on one side, tight supply on the other. That is not a contradiction. That is the setup. And before anyone takes that as a green light, setups take time to resolve. The structural picture is clear. The timing is not. Anyone who claims to know the timing is selling something. Here is the number most people are not talking about. 98. That is the current dollar index level. Now the dollar, because this is no longer a backdrop. It is the primary variable. DXY has fallen from above 101 to 98. That is a 3-point move in weeks. The 10-year Treasury yield sits at 4.30%. That remains elevated relative to metals. Oil prices remain below recent highs amid US-Iran negotiations. That combination matters. A weaker dollar supports metals pricing. Every 1% drop in DXY historically boosts metals by 1.5% or more. Markets are pricing a stable geopolitical outcome. Look at the Strait of Hormuz risk and tell me the probability is stable. If escalation returns, oil reprices higher, inflation expectations move higher, gold reprices first, silver follows with higher beta. That is the historical pattern. Every time supply shock meets monetary uncertainty, metals reprice. It has not been different yet. Silver Western spot at 80.33. Shanghai physical pricing has printed above $82 in recent sessions. That implies a premium of up to $2 per ounce currently. Short term, the structure is tight, but the tape is unstable. The key variable is COMEX delivery behavior. If coverage drops below 10%, stress accelerates. If the dollar rebounds above 100, pressure increases. That is the only short-term read that matters right now. As for trading it, I cannot see a clean picture on the lower timeframes right now. I cannot tell you what silver does tomorrow. Nobody can. If you think you know, good for you. Volatility is elevated into geopolitical events. Sidelines is not weakness in this environment. It is the only edge there is. I have called this market both directions. I will call it again when I see it clearly. Right now, I do not see it clearly. The tape decides, not me. Here is the honest truth. Both sides of this trade have a real case, and the one you ignore is the one that costs you. So let's run both. The bear case is real. Industrial demand is forecast to fall 3% in 2026. Dollar strength above 100 historically pressures silver lower. Peace scenarios reduce safe haven demand immediately. The bull case is equally real. 762 million ounces have been removed from global supply. COMEX coverage at 13.4% signals delivery stress. Shanghai premiums confirm real physical demand pressure. Size correctly. Know what you are in before you are in it. The physical market already knows where this is going. The paper market is still arguing. That argument does not last forever. Everything shown today points to one thing. Structural pressure is already built. The only question is when the paper market aligns with the physical reality. Do not take my word for it. Verify every number I gave you today. Check the data yourself. Silver Institute, CME Group, London Bullion Market Association, logic over hype, always. If this analysis added value, like this video right now, subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. The ones running the OG John AG 1.0 playbook do not wait for the mainstream to catch up. They already know. OG John AG 1.0, out.